Good afternoon, everybody. Welcome back to another enlightening conversation on FinTalk. I'm your host, Renata Joy, and I'm thrilled to have you join us on this journey where we're going to explore the world of finance and wealth building strategies if you've been following us all week. Tonight, we have a very special guest with us, Lesley Batson, the founder and chief wealth strategist at Rebel Rock Wealth, a wealth strategy firm for independent thinkers. She's a financial professional, trusted advisor, an inspiring speaker who is disrupting the herd mentality around personal and business finance. She is known for helping clients create massive amounts of cash flow that they can bank for the future and give them the type of life that they might not have thought was possible. I'm already loving her. Lesley previously worked in various IT roles for 20 years, analyzing and dissecting systems and processes. So her perspective tends to be different from a typical financial advisor in the industry. With candor and the approach that knowledge is power, Lesley educates professionals, investors, and small business owners about how money really works so that they can truly take control of their finances and keep more of it in their pockets. Our kind of girl. She offers workshops for groups and coaching programs like Shift for Women. Join me in extending a warm welcome to Lesley as we dive into today's conversation titled Mastering Money, Essential Tips for Wealth Building Success. Grab your pen and paper. Lesley, welcome to the conversation.
Hi, Renata. Thank you so much for having me.
Awesome. So let's dive in. So Lesley, to kick off this conversation, let's start with some fundamental question. What are some fundamentals about money that we should all understand?
Well, I think it's really important for people to understand. There's several concepts, but at the core, right? We want to make sure that we understand the difference between savings and investing, because cash flow is king, right? We know that in order to be able to invest, you need to have some cash to invest. We know that if you need to be able to cover your living expenses, you need some cash to pay those bills. So the first fundamental thing is that you are maximizing your cash and your cash flow. What I see a lot of people, it's not to point fingers or criticize anybody, but it's just the nature of the system that we're in, right? It's like we're told to go to school, get good grades, and become a great employer for someone else. Well, that's great and all for some people who want to be, a worker, but in very little parts of this education system are we taught how to just manage the basics, the fundamentals. So we might be in the position where we graduate from high school, and maybe we're not in the position where our parents can pay for our college. So it's completely acceptable to go into student debt, right? To get a loan to pay for that education. No one's ever explained to us how interest works, how it compounds over time, how it might take you 20 years to pay back a 4-year degree, all these different fundamentals. And so we're constantly trying to get ahead, but we don't even understand the basics, right? Whether it's just cash flow, budgeting, interest, debt, all those impacts on and all the ways that it can chip away at our ability to move forward and build wealth. So I always say, understand some of those fundamentals, some of those key things that will dig at your wealth is debt accumulation, right? Make sure you get that paid down as quickly and as efficiently as possible. Taxes, right? Whether it's the federal income taxes or state income taxes that we think of, but it's also the, gas tax. Inflation is really like a type of tax. Just understanding all these different things that will all sort of help us to move forward. And sometimes we're looking to make big gains, but slow and steady is okay too. So make sure we understand some of those fundamental things when it comes to money.
I think it's important. And some of it is just basic terminology, just getting yourself familiar with, because you're dealing with it every day, right? If you go to the store and make a purchase, if you're going out to eat, if you're paying your bills, setting up automation, all of these are terminology that you should be well versed with. Good stuff.
Absolutely.
Now, I heard you speak recently about natural balance in our finances. Can you please explain to everybody what is that?
Yeah. So I have a mentor, and he has this thing called the two parallel paths. And I like to think of it as just that natural balance. And it goes along, the story kind of goes, we think of, building wealth we think of investing and accumulating things and accumulating assets. And that is true, right? It's like in order to have more, we need to build and acquire more.
Mhm.
Along that journey, life happens, right? Good and bad. Sometimes things can happen that sort of exponentially grow our assets or grow our money. But oftentimes there are things that happen along the way, some more extreme than others, that can actually impact or slow down our ability to accumulate wealth. And we really talk about those two paths. One is the wealth accumulation path, and one is the protection path. The protection path is what you want to have in place along with the wealth accumulation path. Why? It's kind of like your protector, right? It's kind of like if you think of, someone walking down the road with like bags full of money, they're not going to just walk unprotected. They're probably going to have some kind of bodyguard around them, right? And it's
Right.
the same thing that comes with your finances. So even as you're investing and doing these different things to grow your money, you want to make sure you have different protections in place as well, because typically for pennies on the dollar, you're getting someone else to assume the risk. So whether that's, having the proper amount of car insurance in case you get into an accident, having adequate health insurance in case you get sick, it's having what I call income protection. It's if you get sick or hurt and you can't go to work and your income stops, what type of insurance do you have in place for that? That's what we would call disability insurance in our industry. Life insurance, God forbid, if you pass away and your family and loved ones are, your income is no longer coming to the family. Did you put something in place to replace that income so that household doesn't have to have a drastic change in their lifestyle? There's, umbrella insurance, liability insurance. If you're a business owner, there's so many different types of insurance, but it's about having different protections along the way in case you in case of a lawsuit, or in case you get sick, in case of divorce, in
Mhm.
case of, so many different things that can happen that, you may see your money going up in this trajectory, but then something happens and it's now going maybe more flatter. And, the one thing we can't ever get back is time. So that
Mhm.
natural balance is making sure that you have the adequate amount of protection that's going along with you as your wealth accumulates over time.
Now, is this something that's applicable to a couple, to an individual, a younger person, an older person?
This is every and anybody, right? You don't have to be married to get sick and hurt and your income stop. If anything, it's even more critical for you to have different types of protections in place, because that, if you were to get sick or hurt and you have some kind of disability insurance in place, it's going to cover likely up to 60% of your income. Now, we could deep dive into that, because if you're a type of person who has like bonuses and other things, typically if you're getting coverage through work, it's only going to cover 60% of your salary. So then you
Mhm.
really need to make sure you're covering that gap. What would be lost if you couldn't earn your bonuses anymore. But yeah, whether you're single, divorced, old, young, married or not, you definitely want to have at least income protection. Even if you're not married, life insurance is an incredible, asset class to start to build, because you're able to build equity inside of it, or cash values, is the term we tend to use when it comes to whole life insurance. You can actually build up cash value. So it's a great bond alternative for those of you who like to invest in the market. The
Mhm.
reason that people invest, 40%, equities, or 60% bonds, or 50-50, or whatever that equation is for you based on your risk profile. The reason you do that is because, it's a lot of risk to put all of your money in equities. So you have a blend with bonds. But what if there's other things that you could use as bond alternatives? Life
Mhm.
insurance is one of those things to consider. Make sure you understand how it works. But it truly is a bond alternative. It's really what the insurance companies are investing in, which are good quality bonds. So it gives an opportunity to not only sort of diversify where your investments are, diversify where your savings are, your different sort of buckets of cash, but you also get a death benefit and other living benefits that come along with life insurance.
That's why it's important to actually speak with someone so that you're getting the best protection. Because if you go online and take these quizzes and check out a box, and then get some insurance or the protection, it could be the wrong protection for you, or it may not be part of a long-term strategy for you. So it's important to really speak with somebody, I would imagine, so that you can get the right protection.
Absolutely. And not just the right protection, but adequate protection. So many people are walking around underinsured, right?
Hmm.
Um, just again, if we want to use life insurance as an example, a lot of people will say, "Oh, I get life insurance through my job. It's great." And it's like, okay, right, great. Depending on what level you're at, you might get 3 times your salary or 5 times your salary. But if you're in your 30s or 40s, and that means that it's only going to replace 3 to 5 times your salary. If you were to pass away and you have young kids, is 3 to 5 years of your salary going to be enough to sustain them and see them through college and whatever other plans that you had for your family? In most cases, it's not, right? It's usually not enough at all. And also when you get it through your job, again, take the benefits if you get them. I'm not saying to not get them, but make sure that you're also supplementing on the side, your own individual coverage to make sure that it's adequate enough for your family. The other thing that people tend to come to me about is like, well, you know what, Lesley, I'm really sick of my job, or I have this great idea. I want to start a business. Okay, great. What are we going to do to set you up to make sure that when you're on your own and you don't have these work benefits anymore, how do we make sure that you still have those protections in place? Right? There's lots of options that people have. They just don't know. So make sure you talk to someone before you kind of leave a job and decide to go, do real estate full time or whatever it is that you're thinking of doing. Make sure that you're prepared and you've put things in place. You've got the cash reserves to handle the sort of volatility of cash flow that comes with being an entrepreneur or business owner.
Now, let me ask you this, because I know you deal with a lot of people. What would you say as a conversation starter for someone who's 20s, 30s in their job, and they're hearing this conversation? They're like, I don't know what coverage I have. How do they start this conversation? Who do they go to? And how do they start it so that they can feel comfortable? Because a lot of times I understand people feel a little intimidated. And so instead of them trying to push through it, they just kind of shy away, and then a situation happens, and then that's when the reality hits them. Whereas if they can be a little more proactive, I think just being able to create some thought starters for them, if you have any advice to that person that may be listening.
Yes, and thank you for asking. Because you'd be surprised how many people, 20, 30 years into a working career have no idea where to look to find their benefits. So I would say, whoever does your payroll, if it's ADP, Workday, like whoever does your payroll, your HR company, go look in there. That is probably where you enrolled in your benefits each year. It's typically in November for most people. But each year enrolling in your benefits, or if they're just kind of automatically re-enrolling you for what you had last year, I would say pause. Don't do that. Let's take a review. Each year you should review, even if you feel like your family hasn't changed, or maybe it has, and you just kind of let things roll over. Go talk to your payroll or HR benefits team and find out what coverage you have. What are your benefits? There's usually like an internal website that you can go to download a flyer, or at least look up, bullet points of the coverage that you have. I would say if you can get access to that information, you can, reach out to me or someone that you trust to review those things for you so that you understand what coverage do you actually have. Because a lot of people, like I said, are underinsured. And it's because they thought, oh, I checked the box. I had life insurance at work.
Right.
Insurance at work. But you don't know that it may not be enough coverage. It might be very short-term coverage. Like there's all different, factors and variables that go into different types of coverage that you have.
Right. And from the time you got your job to today, the economy has changed. So there's a lot of reasons why you have to stay on top of it and be adaptable. If you have to make some changes, make those changes.
Exactly. So if you are like a W-2 employee, typically, like I said, you only have that one time a year to make those changes. So when you get those emails like, okay, enrollment period's coming up, don't just, delete the email. Say, you know what, let me stop. I remember Lesley said, let me review what I have and make sure that you're opting into as many services or, benefits that make sense for you. If you are married or you're, have a domestic partner, check and see what your spouse's coverage is at their company. Check and see which one, which one makes more sense for you, especially from a health insurance perspective. Think about, depending on your health, your medical situation, strongly consider getting a health insurance plan with a high deductible, because then you can contribute to an HSA, a health savings account. It's probably one of the few, like government type accounts that I actually like. And it's because you can put money into it without paying taxes. You can put in pre-tax dollars. It can grow income tax free, and then you can use it without paying taxes for qualifying, medical expenses. It could be glasses. It could be, acupuncture.
It is right.
It could be so many things. But ultimately, if you're relatively healthy, you want to max out that contribution every year and don't touch it until you get older, right? Because that's probably when you're going to have the bulk of your medical expenses, is when you're older. And you want to have your money in a vehicle where it can actually grow substantially. And I know we may touch on this, so I don't want to jump too far ahead. But if you have contributed to an HSA at a former employer, you can actually roll that into a self-directed HSA. So if you're not familiar with self-directed accounts, there are custodians out there. So it's not necessarily like a Fidelity or a Schwab. These are, special custodians that are out there where you can open up, an IRA, a Roth IRA, an HSA, but basically you can roll funds from, old employers into these. And then you're not limited to investing just in the stock market. You can invest in other things, whether it's real estate, precious metals, crypto, like whatever you're interested in investing in. And there's very few exceptions. So it allows you to again, diversify what you're investing in and grow those funds. So again, if it's an HSA and it's just sitting in a savings account earning 1%, okay, that's fine. And you do have to leave a portion in there. I think you have to leave $2,000 in there, but above and beyond that 2,000, you can invest. So do that. And because it can grow income tax free. And those are funds that you can use down, again, when you get older.
Now, I know Lesley is using a lot of acronyms, HSA, and you're probably, what is she talking about? I promise you, don't allow that to intimidate you. That means you should do some research, do your due diligence, and understand, because lack of knowledge is not an excuse today. With the information that we have available to us, the people that we have, such as Lesley, that will be more than happy to explain it to you. So Lesley, your insights on finding a natural balance in our finances has truly been invaluable here, or enlightening, I should say. But let's delve a little bit deeper into practical aspects of wealth management. Can you share with us 6 major wealth destroyers that individuals should be aware of?
Okay, yes. So I kind of touched on a couple of them before, these first 2 might not seem obvious, but I really like to have people think about, number 1, their knowledge and understanding. Okay. If you are tuning into this program, kudos to you, because you're taking a step to build your knowledge and understanding when it comes to money and finances. Okay. But a lot of people don't. Many of us bury our head in the sand. Like I mentioned before, we didn't necessarily have, personal finance classes in school or anything like that. We went through college. I was a business major, never had a single personal finance class, but I had finance for business. I had economics, but nothing for my own personal wealth. So if you are, sort of the type that's maybe a little afraid of money, or it makes you nervous, you lack confidence, do not bury your head in the sand. Reach out and try to find someone or people who you can speak with, who can help you build your confidence when it comes to money. Because there's nothing more important than building confidence, because nobody is responsible for your money but you. You can hire a financial advisor, you could do all these different things, but you're the one who's giving the yeses or the nos or the approvals or the declines. You are responsible for your money. You earned it, and you should understand how to grow it and how to keep it. Mm-hmm. So knowledge and belief is so, so important. If you don't have those things, it could truly destroy your wealth or affect your ability to build wealth. So that's the first one. The second one, also probably not what you think about, is health. Mm-hmm. So it doesn't matter how much money you make. It doesn't matter how great your investments are, your return, your ROI or anything like that. If your health is poor, and not just your physical health, your spiritual health, even your psychological health, it can affect your ability to make decisions, or decisions can be made for you, right? If you don't have great health, if you're not taking care of your body, you know what? You may not be able to get life insurance. You may not be able to get disability insurance. Then what happens? What would happen if you get sick because you're not taking care of yourself? What happens if you can't work? How does that impact your whole family? Not just you, but your family. Oftentimes in our community, we are taking care of other people, whether it's a parent or parents or kids, whoever it is. If your income is interrupted, how will that impact you? So you must take care of your health. That can completely destroy your wealth. There are countless families who've had to file bankruptcy for medical bills. Okay. Make sure that you are taking care of your health and prioritizing that. So after knowledge and health, it's the ones that you might think of. Okay. So taxes, I kind of touched on that earlier. So you have all these different types of taxes that eat away before your paycheck is even deposited. Uncle Sam is withholding, funds because they want to get that every April 15th. Okay. Or business owner every March 15th. So think about taxes and how those deplete or eat away at your wealth. What can you do creatively to position yourself to be in where the taxes are lowest, right? Employees, you are paying the highest amount of taxes, right? You're paying ordinary income tax rates. So think about it. How can you transition or move or
Offset it.
some of your income to not be ordinary income? Maybe you can open up an LLC, maybe you can start a business and start to have some income that comes in that way. Maybe you can have some 1099, because businesses are taxed at a lower rate than ordinary income. If you think about your investment income, okay, if you have capital gains taxes, which means that your investment has been in place for more than 12 months, you're at an even lower tax rate, right? So think about how can you reposition your income or your assets even to be more efficient with your taxes, okay? So taxes, okay. The other thing is inflation, okay? So we touched on inflation as well.
Mm-hmm.
So inflation, the cost of living. If you think about, I don't know, what could $1 million buy you 10 years ago versus what it could buy you today? I live in Orlando, Florida, and 10 years ago, you could probably buy a great like 4-bedroom, 3-bathroom house with a pool for, $300,000. Okay. You cannot do that today.
No.
In very few neighborhoods can you do that today. Florida has just, the population has just not coming here. So the cost of housing, everything has gone up. So imagine that you are, coming out of school and you're thinking, okay, great. I've now got my degree. I'm working and I can buy a house. Most people can't really afford to buy a house right now coming out of school, right? So we have to think about inflation. We have to think about how do we make sure that we are managing for inflation. For those of us who might be in our, 40s and 50s now, think about 10, 20 years from now. If you're in retirement phase of your life, what are the costs going to be? 20 years ago, think of what something cost 20 years ago and think what it will be 20 years from now. We have got to make sure that we are putting enough money away so that we can afford to maintain our lifestyle in the future. Okay. All right. So then the other thing would be opportunity cost. Now, opportunity cost is something that it's a term you may not have heard, but it is truly that. It's like, what is the cost of opportunity A versus opportunity B? One example I like to use is when we think of mortgages, right? We've got 30-year mortgages and we have 15-year mortgages.
Mm-hmm.
So what is the opportunity cost of picking a 30-year over a 15-year or vice versa, right? Mm-hmm. So we know in general, a 15-year mortgage is going to be offered to us at a lower rate. And most of us say like, hey, okay, great. If I can afford it, let me just jump into a 15-year mortgage because I get a lower rate. But if you work out the numbers, yes, in total, you will end up paying less money in interest. Mm-hmm. But there's an opportunity cost because your minimum payment for that 15-year mortgage is going to be higher than the 30-year, probably, double at least, right? So if we were to use like round numbers, let's say that your mortgage payment was going to be $1,000 a month if you had a 30-year mortgage, but it would be $2,000 a month with a 15-year mortgage. So that's an extra it's an extra $1,000 each month that you have to come up with and pay on your mortgage because you have to. That's the bare minimum. And it also means that $1,000 didn't have a chance to earn anything else, right? Mm-hmm. So there's that opportunity cost. It didn't get to grow over that 15-year period because it was getting put right into the mortgage. Mm-hmm. And who benefited from that? Mm-hmm. The bank, right? Like, yes, you're building up your equity faster, but it's because the bank is really getting that money. Okay. Mm-hmm. If you have a 30-year mortgage, it doesn't mean that you can't put an extra $1,000 a month, right?
Exactly.
But maybe you only want to put an extra $200 because you have something else that you can deploy with that other $800, and it's going to grow a lot more. And maybe when you get to the 15-year mark, you've built up enough money that you can just pay down and pay off in 15 years. Exactly. Like a lot of different options and opportunities that you can have, with choosing a 30 versus a 15. So that's just an example of opportunity cost. And then the last thing would be fees. Okay. So when we think about something like a 401k plan, it's the example I like to use because everyone can kind of relate to it. 401k has been sort of touted as, the holy grail of retirement. For some reason now in America, we have, again, not to criticize, it's just if you want to call it propaganda, right? It's like that information that's out there. As soon as you get a job, boom. In fact, there are people who will make a decision on even going to a company if they offer 401k or not, right? They hold it in that much importance. but most people don't really understand how a 401k works. So you have to make sure that you understand that, number one, if you're putting in pre-tax dollars into this account, it's going in there. So yes, you got to, some tax savings in the current year because you put that money away. But if you've been doing that for 20, 30, 40 years into an account and you've not paid taxes, that money has grown, assuming the market has grown. So the amount that you've put in has now grown. So the amount that you pay in taxes has now grown. Oh, by the way, along the way, you've had to pay Wall Street fees for all those funds that you've been investing in over that 20, 30-year period. And a 1% fee could easily equate to at least 10% of your wealth that's getting lost just to the fees. Okay. So if you think about taxes and the fees and the opportunity cost, what else could you have done with some of those dollars if you'd put them somewhere else, if they weren't locked up inside of a 401k? And I know a lot of people are lured by the match, right? By their employer match. Again, I challenge people to do the math. If you want, I can help you do the math and show you what it looks like for you in your situation. And you can decide, is it worth it to continue to direct my dollars there? Or should I redirect it in other places where it can grow and I have much more control over it? And also, I'm not subject to whatever the tax rates will be in the future. I already know what the taxes are today. Right now, it's the lowest our taxes have ever been. They're never going to be this low again. I don't know about you, but I really like to buy things on sale. I can like to pay the taxes today, get it out of the way, and let the rest of it grow tax-free. So anyway, long answer, but those are 6 things I always encourage.
I loved all 6 of the wealth destroyers, especially the opportunity cost. Like I understood the concept, but I had never heard the term. So thank you for breaking that down. That was great. Very vivid. Now, so you talked a lot about investing. What is investing? And also, when is it a good time to invest, to start? Should I wait till I'm older in retirement? Is this something I should start thinking about today and sharing with my kids? Like, what is it and when should I start?
Yeah, so great question. So I touched on this earlier when I said understanding the difference between savings and investing, right? So FINRA, okay, it's the organization that regulates our industry. They put out a definition, right? So I tell people, you don't have to take it from me. And you can say it's semantics, but it's true. And I want people to think about this way. Savings is typically where you're putting money into a vehicle where it's likely not going to grow a lot, right? You're going to have a low interest rate, but your principal is going to be safe, okay? Typically, your principal is guaranteed to not go anywhere. So you put in there and you know it's going to be there. An investment, on the other hand, is where you are putting money into some kind of vehicle. There's some degree of risk. There's definitely a range, right, of risk, but it's at risk. That means the principal is also at risk. So it means whatever you're putting your money in, it is subject to being lost. Okay. So what does that mean? It means you need to think about, are you ready to invest? Do you have permission to invest? So, for example, if you are someone going into a new job today, they are typically automatically enrolling you into a 401k and automatically starting to take 3% of your paycheck and putting it into this plan. Now, for some people, they might be okay with that. For other people, they might have $10,000, $20,000, $40,000 in credit card debt. They might still have $30,000 in student loans. It does not make sense for you to continue to accumulate interest charges on your credit card at 15 or 20%, or some cases 29% interest, to potentially earn, 6, maybe 10% in a 401k plan before taxes. Okay. What I tell people to do.
Potential.
I'm sorry?
The operative word is potential.
Potential. Okay. Whereas, I tell people the best investment you can invest in is paying down debt, right? Because it's automatically going to reduce that 29% debt. It's going to automatically reduce that, 10% student loan or 8% student loan, whatever it is. Now, I'm not saying to completely ignore investing until you've paid down all debt, but you definitely want to try to pay down debt as fast as possible because of that, the law of compounding, right? Mm-hmm. People love the concept of compounding when it comes to their earning money, right? But they don't like to think about it when it comes to the debt. But it's the same thing. It's just in reverse. So the longer you let that debt sit there, the more it's costing you over time. And time is so important when it comes to investments, right? You really want to allow as much time as possible, but you want to have permission to invest. You want to be in the right position. So what's the best investment? I tell people, paying down your debt. That's the best investment you can have. But the second best, I would say, is number one, understand your own risk profile. Are you, what keeps you up at night? Do you like the stock market? Are you scared of the stock market? Do you like real estate? Are you not interested in real estate? If you are interested in real estate, are you looking for cash flowing type opportunities? Are you looking for long-term hold opportunities? Like, understand, number one, educate yourself on the different types of investments. But number two, understand your own personal risk profile. If you do want to get into real estate investing, do you want to be a landlord? Do you like dealing with people? Because you will be dealing with people. Can you deal with that? Or are you willing to, give a percentage to someone else to manage that part for you? Do you want to, have real estate where you live? Do you want it to be elsewhere? Like, understand all these different factors. Do you want to make sure that you're diversifying the risk? Maybe you want to have some precious metals. Maybe you want to have, maybe you're interested in crypto. But understand what the different types of investment opportunities are. Understand what your risk tolerance is. Understand how much it takes to actually successfully get into a particular investment. There are some opportunities that you need to have, a minimum of $25,000. Some things you can just do $100 a month, right? Some things you need to be an accredited investor. An accredited investor is I guess a qualification that the IRS has deemed for certain investors. If you're single and you earn $200,000 a year and you have, and intent, and you likely still will, and you have $1 million in assets, not including your primary residence, and if you're married, it would be 300,000. If you meet that standard, you would be considered an accredited investor. And in that situation, the SEC will say, okay, it's okay for you to, basically be invited to participate in certain types of investments that they deem to be higher risk, right? Probably because they're not in the market. But again, you always have to understand the system and how they define things, okay? But they deem it to be higher risk. And not to say that there aren't risky things out there, but they feel like, well, you have enough assets, you have enough liquidity. If you lost all your money in that particular accredited investment, you still have enough to move forward. If you don't reach that, if you don't meet that threshold, then they say, well, you know what, we don't want you to, have lost your last dime on this opportunity. So, we would prefer, or we would, we are saying we don't want people who are not accredited to invest in this particular opportunity. So you may hear about those things as well. Now, those typically also have larger investment, requirements, but they typically also have higher returns. So again, you just need to understand, where are you in that whole mix? What is your risk tolerance? How much do you have available to invest? And how do you want to invest? Understand, investing just from your cash, right? Do you want to invest from a retirement account? Like there's just different ways that you can, do you want to leverage, assets that you have and invest? So there are different ways that we can, talk about helping you to grow your wealth. But again, making sure we have those protections in place along the way so that, we are buffering and managing the risk.
That's why it's important to get connected to a knowledgeable advisor or professional like Lesley, because Lesley just kind of gave you a framework of some of the questions that she will go through with you, because it's not a one size fit all. She's not going to give you a cookie cutter experience, because everybody has unique, situations that they're dealing with, that it's not going to look the same for everyone. So I do love that. Now, you talked about being risk adverse. Lesley, are you still with us? I think she's frozen. But it's important to really make sure that are you there, Lesley? I think you froze up a little bit. But yes, it's important to really get connected to someone who can really walk you through the process. Are you there, Lesley? I think she's a little frozen.
Oh no.
So
I'm
are
here.
you there? Can you hear me?
Yeah,
Okay,
I can
awesome.
hear you. I'm sorry.
Okay, you're back. No, that's good. I was just explaining to them that it's important to get connected with somebody who really understands that everybody has a unique set of restraints and variables that they're working with, that you cannot give them a cookie cutter experience. So I think that that's important. So you talked about investing. Can you share with us, like you kind of touched on it, but I want to hear you actually say, like, what investments do you actually recommend? Because there's so many out there, as you kind of alluded to a few minutes ago.
Yes. So again, I will say that for everybody, everyone's different. So it depends, right? So it depends on your risk tolerance. I would say it is always good to diversify, right? So if you are someone who is maybe a little more risk tolerant and you feel comfortable investing in the stock market and you feel comfortable investing in individual stocks, then go ahead and educate yourself about different companies that you're interested in and learn about, understand the different ratios, right? If you go to say Vanguard or Morningstar or something like that, and you see, sort of like their report on each company, make sure you understand what it's saying before you choose to go ahead and invest in that company, right? Maybe you have a strategy. Maybe it's like, okay, I'm going to invest at X price, and I want it to go up to Y, and once it reaches Y, I'm selling. Or at least I'm going to sell back enough to get back what I put in, or, put your own little strategy together. But it could be, again, investing in individual stocks. It could be investing in, mutual funds, but make sure you understand, again, the fees that are involved in mutual funds, at least that are actively managed. You could choose to invest in ETFs, but understand that if you're investing in ETFs, you're not getting the dividends that are paid out like you would in a mutual fund, right? So understand the trade-off, to the pros and cons to each different type of investment. Me specifically, a lot of my clients tend to invest in real estate. So there's different, areas like I touched on with real estate. It could be multifamily syndication. It could be buying single families. It could be land, flipping. There's really a broad range, but understand, do you want cash flow to come from this particular investment? Or are you holding on, like you're purchasing this asset and you want it to appreciate over time so you can get that sort of long-term long-term investment, long-term benefit of this particular property? There's really so many different types of strategies. So I think it's hard to answer what are the best investments, but I tend to help my clients understand how they can invest beyond the stock market, because that's just not the only place. Definitely hurts to spread the risk beyond the stock market. Mm-hmm.
Yeah, don't put all your eggs in one basket.
Correct.
Definitely. So what strategies can people use to build their overall financial portfolio?
Well, I would say make sure, I kind of sound like a broken record, but make sure that you have cash, right? Like the one thing I like to use and point people to an example so they don't feel like I'm just making it up. I tell people, just go into Google and type in CNBC Warren Buffett portfolio. Anyone can do that at any time, because it's basically a tracker that's kept up daily, I think, or at least hourly. Wow. And you can see how Warren Buffett, how his portfolio is for Berkshire Hathaway. And it has all these line items of all these companies he's invested in. And the very last line item, it shows how much cash he holds. Okay. And he holds a lot of cash. It's usually anywhere, at any given time, it's anywhere from, say, like 10 to 20% of his portfolio is cash. So when people say to me, cash is whack, which I've heard many times, cash is whack, cash is not whack, right?
No way.
How is Warren Buffett able to take advantage of the incredible opportunities? Because he has cash, and he makes sure that he always maintains his portfolio with a certain amount of cash. If he's dipping below that amount, he changes it to make sure, he might sell some things off, whatever it is, but he makes sure that he keeps a certain ratio or proportion of cash, because cash is king. Cash is the opportunity. So I think it's really important to make sure that you yourself are building up your own cash reserves. Okay. Secondly, like I touched on, building in your protection. Make sure you have your protection, in place. Third is then going into investments and making sure that you are finding ways to multiply your money, faster or more than you would in sort of a savings or principal managed type of, account or vehicle. But it's important to have all three, because you really need to have all three. You really need to have the wealth accumulation portion, just because, inflation, just to keep up with inflation. You need to have something that's going to grow, faster than, like a savings account. But Also, if you have debt, that's really just eating up anything that you're gaining anyway. So make sure that you're, part of your strategy is around paying down that debt.
Mm-hmm.
And then sort of putting the bow around everything is estate planning. So whether you're single with no kids or with a family or multi-generation or a business owner, especially, it is super, super important to understand, estate planning and what that means for you. So whether it's just the will or a trust, it could be just having what is it? The word's escaping me now, but a health advocate, right? The word escaped, the attorney. I'm drawing a blank, but you want to have someone who can kind of speak on your behalf or, sign documents.
The state attorney?
Not the estate attorney. The term is escaping me. But it's someone who you would have documented to say that if I'm incapacitated and I can't speak, this
your
person
executor or your executor, isn't it your executor?
Well, your executor is sort of the title once you've passed away, but while you're alive, it's something of a power of attorney. Sorry.
Okay. Yeah.
Power of attorney. I could not get the word. So sorry. So power of attorney. You want to make sure you have someone designated who you trust to be your power of attorney, because if you cannot speak or make decisions for yourself, this is the trusted person who can make decisions for you. And you may choose to have different people. You might have someone who's power of attorney over, say, your health decisions, and maybe someone separate who's over your financial decisions, someone who's different you trust. Because you want to make sure this person's not going to be just writing checks to themselves. They're going to be keeping your bills paid. They're going to make sure the hospital coverage is paid, like whatever expenses you have. If you have kids, that their school's still getting paid or daycare, like you want to make sure you have trusted people identified. So it doesn't matter if you don't have, $1 billion estate, if you have children, if you have pets, if you have property, you want to make sure that you have at least, a will, at least a power of attorney, at least a health advocate identified and documented. And you can have an estate planning attorney help you to do all this if you, have a more complex estate. But even for, even if you just have a simple estate and just want to get something put in place quickly and it's more affordably, there's a company called Will and Trust, and they, can kind of walk you through a wizard to kind of guide you through how to complete those things. And it's really just a few $100s. So there's really no excuse. It's really maybe sit down, dedicate, a Saturday or a Sunday, or just dedicate one day to kind of focus, get all your documents together and get it done. But it's definitely one of the things that most people put to the side, but it's, it's one of the things, well, it could be too late, right? You don't want to have something, left to the probate courts or left to your family to decide, right? We've all seen the horror stories of celebrities whose estates are still not settled years after they passed away because they didn't have things, finalized.
Right. And like you said, it doesn't matter if it's not as big as people usually think that you have to have $1 million of assets before you can even start thinking about, getting a will and trust in place. And like you said, it's for that time that unknown time that you don't know that you're going to need it is when you need it. So It's important. And there's no excuse. Like you said, there's that will and trust. And I've seen their commercials. So they're everywhere.
Yeah. And it's, I have several clients who've used it. It's easy. It just walks you through the process. And I would even say, even beyond that, that's like, doesn't even cost you anything, just maybe cost you a few minutes, is your bank accounts, right? On your bank accounts, investment accounts, there's something called a TOD, transfer upon death, or transfer on death. You just designate who that person is. And then those accounts are automatically, get access to that person who you've designated. So it doesn't even have to go into a will or a trust or anything like that. Make sure that your beneficiaries are updated on your retirement accounts, Social Security. If you are divorced, make sure that you've updated your beneficiaries, because your ex-spouse will get those benefits if you don't make those updates, right? So there's a lot of things you can update that can make, an immediate, kind of an immediate effect on your family, whether you're sick or whether you pass away. That doesn't cost you anything to do.
I like the fact how you said earlier, this is something that you should go through annually, because changes do occur and you may not think about it. You probably had your job 10 years and God forbid, now you're getting a divorce, you're not thinking about what you did 10 years ago. But if it's something that you've done habitually where you're sitting down annually, then you'll know to make some of those changes. So I like
Absolutely. Absolutely. And if you have a financial advisor and they're not reaching out to you annually, you need to, maybe think about getting someone else who's going to be a little bit more invested in your, in your situation because, you can't know everything, right? It's great that we have the internet, we have resources, we can put together opportunities like this for people to learn. But, it's really important for you to work with specialists, work with people who do this stuff every day and they know. And if they don't know, like I don't know everything, I'm not an estate planning attorney, but I know some of those fundamental things. And I can put you in contact with this, an estate planning attorney in your state because they will vary by state, but I can at least get you there, right? But don't just kind of ignore things. Don't bury your head in the sand. Make sure that you're being proactive when it comes to your own finances, because what is all this work for? What are you earning all this money for? For it to be lost to the IRS because you didn't do the most tax efficient thing,
Right.
or because, you're going to lose all this money in fees because you just, dumped it somewhere and ignored it. And, which a lot of people do, they start a 401k or whatever, and they never go back and look at it. I would say just revisit it.
I love it. Now, Lesley, honestly, I could talk to you for hours because this conversation is definitely something that I'm intrigued with. But as we wrap up our conversation, what is the most effective way to close the wealth gap? Because this one is important for me, because my mission is really to shrink this intergenerational wealth gap. So I want to hear from you. What are some effective ways to close the wealth gap?
Well, honestly, I feel like obviously building up your knowledge and experience and your confidence when it comes to money is super important, right? But really the most effective, strategy or tool you could say that most families could put in place to really help to close that gap is life insurance.
Mm-hmm.
And why do I say that? Because as hard as it is for people to realize or admit, we're all going to die. It is a certain event. We don't know when,
Right.
but we know it's going to happen. So what are we doing while we're living to make sure that we're closing that gap for the next generation? Well, life insurance, again, like any insurance, but life insurance in particular, is like pennies on the dollar ability to have a death benefit that will go to your loved ones, income tax free, right? And that is now, the second thing is you need to make sure that those family members understand how to manage that money so that when the money comes in their hands, it's not just blown.
Mm-hmm.
So that's why I like to work with, families and their kids or whoever their, beneficiaries are, because it doesn't make sense. You did all this work your whole lifetime and you spent every dime, but then you left a death benefit to your kids and then it's gone in 10 years, right? On average, there are statistics that show within 9 years, most families that have passed wealth on to the next generation, I think it's like 60%, is gone within 10 years. And it's really because that next generation bought cars or bought whatever, spent it on whatever, but they didn't know how to keep that money building and growing. And that's also part of what estate planning can help you to do. So life insurance is one of those things that for pennies on the dollar, you can use it during your lifetime, but then when you pass away, it's a huge windfall to your family that really helps to close that wealth gap.
Awesome. Now, as we draw this conversation to a close, Lesley, I just want to extend my heartfelt thank you for sharing all of your invaluable insight and information. Your expertise really shine through. I know our audience have walked away with a wealth of information. But before we conclude, I'd like to invite our viewers to seize a special offer from Lesley. She graciously has offered a complimentary gift, 30 days to cash flow control. Now, to access this resource, simply send an email to hello@renardajoy.com. And I want you to share with me your key takeaways from this conversation. Now, Lesley, as they're writing down this email address, I want you to tell us a little bit about this gift, the value out of it. What will they get from this experience with this gift? And thank you so much for extending this to our viewers.
Absolutely. So what I have, when I've done this with other clients, what we've done is be able to identify opportunities to improve their cash flow immediately. So I'm going to take a look at your pay stubs Okay. Whether you're a business owner or employee, whatever it is, take a look at your pay stubs and look for opportunities there. Secondly, we're going to get you set up with a program that I use called Currents. Okay. And this is basically a strategy that it's a software, I guess, but it's a strategy that I use to help clients build up their cash flow. So even if you feel like you're in a position where you don't have a lot of extra money after each paycheck, I promise you that we're going to start now. We may not see all that in 30 days, but certainly within 90 days, I've had people start to see that change. So it depends on, how much money you have left over after each paycheck, but certainly within 30 days, doing an analysis of your paycheck, I have yet to work with someone who has not been able to see a difference.
Wow. Well, for those of you who are eager to delve a little deeper with Lesley and her expertise and including getting on her mailing list, feel free to reach out to her. Here's her website, all of her different platforms that you can follow her, that's displayed here on the screen. And once again, Lesley, thank you so much. I really appreciate your time. I could tell that you're very passionate and you have been a wonderful guest tonight. And for those of you who have been following us from the beginning of this series, I want to thank you for your continued support. And if you're just joining us, no worries. You can join the conversation as well. We do have a playlist. It's called FinTalk, where you can go back and listen to all of the valuable conversations that I've had with all of our other speakers, including this one that we're having with Lesley. That's going to be in our playlist. Don't forget to like, share, and subscribe, and ensure that you get all of our notifications. Mark your calendars because we will be back on Friday at 1 p.m. with another great conversation. And remember, every step that you take towards financial literacy and empowerment brings you closer to achieve your dreams. So make sure that you keep learning, keep growing, take an action, and I promise you, you will be able to thank your future self. So until then, have a great night and thanks again.